All right, let's jump right in. Today, we're going to tackle one of the biggest questions in finance. How do you figure out what a company is really worth? We're going to pull back the curtain on a powerful method called discounted cash flow, or DCF. Let's get into it.
Think about it. It seems simple, but it's not. When you buy a stock, you're not just buying a ticker symbol, you're buying a tiny piece of a real business. So how do you know if you're paying a fair price? Is it all just based on the latest market hype? Or is there a way to figure out its true deep down value?
You know what? To really get this, let's forget about finance and stocks for just a moment. Let's talk about something much simpler. Let's talk about buying an apple tree. See, its value isn't the wood, right? Its real value comes from all the apples it's going to give you in the future. So how in the world do we put a price on this apple tree? The answer, as you probably guessed, is tied up in its future harvests. But there's a little twist. It turns out not all apples are created equal, especially when time gets involved. Just think about it for a sec. Which would you rather have? 10 apples right now, in your hand, or a promise for 10 apples exactly 1 year from now? Yeah, you'd take them today, of course. An apple you have right now is just worth more than one that's still on the branch. And this simple idea, well, it's the foundation for everything we're about to do. So this gut feeling, this preference for having things now instead of later, well, in the world of finance, it has a name. It's called the time value of money, or for our little story here, the time value of apples. This is the first big piece of the puzzle. It's one of the most important ideas in all of finance, really. Money today is more valuable than the exact same amount of money in the future. Why? Because you can put today's money to work. You can invest it and it can grow. Just like an apple seed can grow into a whole tree, your money can grow over time, but only if you have it now. And this just makes it crystal clear. If you get 100,000 rupees today and pop it into an investment that earns just 5%, you'll have 105,000 rupees in a year. So that means getting 100,000 rupees a year from now is actually worth less than getting it today. The big takeaway here is this. To value our tree, we have to take all those apples it's going to produce in the future and figure out what they're worth in today's money. Okay, so if the tree's value is all about its future apples, then our very first job has to be predicting how many apples we're actually going to get. This part is all about looking into the future. So, what's that harvest going to look like? Are we talking 100 apples next year? Maybe 120 the year after that? Is the tree still growing, or has it matured and its production is kind of leveling off? These predictions, these educated guesses, are the absolute heart of our valuation.
And this is where the analogy gets really cool, because a company's life cycle is a lot like our apple trees. When it's just starting out, it's like a little sapling, no apples yet. Then it hits its growth phase and the harvest just explodes. Finally, it matures into a stable company, producing a nice, steady crop year after year. So you can't just make a blind forecast, you gotta know where the company is in its journey.
So in the real world of finance, what are our apples? Well, they have a name: free cash flow. It's the actual cold, hard cash a company has left over after it's paid for everything it needs to run and grow the business. It's the profit that could, theoretically, be handed back to its owners. This is the magic number we're trying to predict.
And we can look at this in two different ways. We could try to value the cash flow of the entire business. That's kind of like putting a price on the whole orchard. Or we could look at what's left over only for the shareholders after everyone else has been paid. And that's like valuing just your share of the apples. For now, the important thing is just knowing that we're forecasting the cash the business churns out.
Okay, so we've got our forecast for the apples. Awesome. But a forecast is just a guess, right? The future is uncertain, and we have to be honest about the risks. What could possibly go wrong with our perfect little apple tree?
Well, a whole lot, actually. There could be a drought and our harvest shrinks. What if a huge, shiny new apple farm opens up down the road and drives prices down? Or what if, overnight, everyone decides they don't like apples anymore, and now they only want pears? Every single business faces risks just like these: recessions, new competitors, changing trends.
So, how do we possibly put a number on all that uncertainty? We use something called a discount rate. Think of it as a number that bundles up the time value of money plus an extra penalty for all those risks. The riskier the business, the higher the discount rate we use. And a higher discount rate means those future apples are worth less in today's money. We are getting so close. We've forecasted our harvest for the next few years, and we figured out how to account for risk. But what about the really, really long term? A good company, like a healthy tree, is supposed to be around for a very long time. This is where a concept called terminal value comes to the rescue. Look, we can't forecast cash flows every year forever. That's just impossible. So what we do is we forecast for a specific period, like 5 or 10 years, and then we calculate one single number that represents the value of all the cash flows from that point on into infinity. It's our best guess of what the whole orchard is worth for the rest of its life.
All right, we have all of our ingredients. We've got our apple forecast, we've got our risk assessment, and we've got our long-term value. Now it's time to put it all together and figure out that final price tag.
And here it is, the entire process in 4 steps. It's actually pretty logical when you see it laid out. 1. Forecast the apples, your free cash flows. 2. Figure out the discount rate based on all the risks. 3. Calculate that terminal value for the long run. And finally, step 4. You take all those future numbers and use your discount rate to pull them all back and see what they're worth today. That's it.
And this is what it looks like when you write it as a math formula. Now don't let it intimidate you. Seriously, you don't have to memorize it. The important thing is understanding the logic we just walked through. This formula, it's just the recipe that puts that logic into numbers.
Now, this DCF method is incredibly powerful, but it is not a crystal ball. Its biggest strength is that it forces you to tune out all the market noise and think really hard about what a business is fundamentally worth. But, and this is a big but, its greatest weakness is that the final number you get is extremely sensitive to the guesses you make about growth and risk. Change your assumptions just a tiny bit, and your valuation can change a lot.
And that leaves us with this final, really fascinating question to think about. If every valuation is ultimately built on a story about the future, an uncertain, unknowable future, can anyone truly know what a company is worth? The model gives us a powerful tool, but the true answer? Well, that might always be just a little bit of beautiful, calculated guesswork. Thanks for tuning in.